A warm welcome to this next Calico webinar. We've been running these for a number of months since last September, so I hope you've been able to join some of the other topics. Today we're talking about funding and business finance with Trish from Hazlewoods and Stuart from Acorn Business Finance. They will introduce themselves in short order in a moment. But for anyone who's new to the Calico webinars, this is how it runs, some admin side of things. Please remain on mute unless you're presenting or for the discussion bit after. We're running in webinar mode today because we do have so many attendees. So if you want to ask a question, please use the Q&A function, which all the panelists, myself and the co-host can see, or the chat function if you're happy to ask your question in public, I guess. Use either of those functions to ask a question of the panelists at any point, and they'll get to your question by the end. We have included a couple of anonymous polls to find out what's happening in your firm, which would be really helpful if you would participate in and give us an idea on what's happening on finance for your law firm, which will help the speakers tailor what they're going to say next. And we're aiming to finish at 10:30 formally, but I will leave the session open for any questions afterwards if you'd like to ask any questions of the panelists at that point. So if you're new to Calico, obviously you found us through the webinar side of things, but we also produce a regular magazine, which you hopefully have seen through LinkedIn. It's hosted online. You can also find that on the homepage of the website. And that's all about reimagining a law firm. 12 articles from different members of Calico, all about thinking differently, particularly with the last 12 months in mind, but also suitable for the 2020s, if you like, the modern law firm approach to loads of different topics. So do check that out. And our purpose is to share our business knowledge and know-how and just the experience that all of the members have had in this sector for so long. So we are now a group of 16 companies and everybody is handpicked to join. We go through due diligence before they can join. And really it's all about sharing their knowledge to help you grow and develop your firm. Obviously, they are doing that in the hope that to build relationships with you. So if you do have a requirement for anything that our members do, please do get in touch, which would be really helpful. Here's our entire group as it stands today. So the group really could help your firm from everything from digitizing your incoming post through to finance, and we're hearing from Hazlewoods today, through to developing your culture and values, through to your PII from Lockton, through to developing your people and networking skills and marketing and digital dictation and outsourcing cashiering and lots more that I've not got time to run through now. But you can find a copy of this membership tree, as I call it, on the website under this URL. And you can download that as a PDF also to read more about what everybody does. And there's everyone's contact details on there as well. So a good one to keep handy when something comes up in a partner meeting that you might need some help with. So just a heads up to the next webinar date, which is the 24th of June. It's all about getting to know you, in the words of Julie Andrews and that fantastic song. I'm actually presenting this one as with my marketing hat on, with the ever brilliant Victoria Moffat from LexRex Communications, supported by Legal RSS and Tricres, all about how your target market can actually get to know you. It's the first bit of the journey from the relationship building, really, the know, like and trust path on the marketing side. So do join us again next month, and that'll be with me and Victoria. So moving on to today's hot topic, law firm funding and finance. So I'm very pleased to hand over to Trish and Stuart, who will introduce themselves, and I'll kick off Trish's slides here. Thank you.
Thank you, Pauline. Good morning, everyone. Lovely to see so many of you. And Thursday means Finance Day. It's all about cash, and we're going to be talking about the internal side of what's happening in law firms as well as what's out there externally. My name is Trish Kinahan. I'm a joint head of Hazlewoods legal team. So we look after a number of law firms, probably over 150 law firms now on a regular basis, as well as doing ad hoc project work on very broad range of subjects. You name it, we're doing it. Our emphasis is about looking at businesses in a different way and coming up with ideas that perhaps people haven't thought about, which suits Calico perfectly because it's all about thinking outside the box. Let me introduce Stuart.
Morning, everyone. I'm pleased to say from a sunny Cheltenham this morning. So I'm founder of Acorn Business Finance. My background is in organising funding solutions for law firms and other professional practices, but we tend to predominantly work with the legal sector, and Trish and I have worked together on a number of clients in the past for an array of funding requirements, which we'll run through later on. But yeah, essentially we're a finance brokerage that work with the best alternative funders out there for the legal sector.
Wonderful. Next slide, please. So let's start at the beginning, and let's start with March 2020. What an interesting month, and perhaps what we would say is the month that changed all our lives, both personally and business-like, probably forever. And I think listening to the news yesterday, whatever we felt last year, particularly in March, if we're having a bad day, it was nothing in comparison to what the government were having. I always think that when I'm having a bad day, someone's probably having a worse day, and it was proved yesterday in the news. So take comfort from the fact that we were all suffering last year. And actually the Law Society did a really interesting poll. They did a very snapshot poll after about 1,000 firms. And out of that came this massive headline that made the Sunday Times that 70% of law firms would fail by September 2020. I know Stuart and I were probably thinking at the time, well, that's interesting. That's our business gone. And the repercussions would be massive. But in reality, what happened is if you roll forward 12 months, next slide, please, it was completely different. What happened in actually by the end of September 2020 is not 70% of law firms failed, 4.8% of law firms failed. And it wasn't because of COVID. There were a number of reasons why things failed. But what we have seen as a result of the last 12 months are profits up. I've got some clients that said it's the best year they've ever had in terms of profit. Turnover might be down, but partners couldn't go out and spend any money. They couldn't do any entertaining. They couldn't travel anywhere. Amazing what overheads were saved. Granted, we had to spend some money on IT equipment and getting that ready, but that was a really good investment for the future. And perhaps we should have spent some of that money beforehand. But overall, profits up. Cash flow is really positive, and we want to focus on that both in the short term and the long term. Productivity is higher, depending on which expert you talk to. Average productivity is increased by about 2 hours per day. That commute that people have saved seems to have gone into extra productivity. As owner of law firms, that's great. That means increased productivity, increased profitability. So overall, I think the last 12 months could be summed up as it could have been a lot worse. Stuart, do you agree?
Yeah, definitely. I think the last 12 months were a shock for everyone. The firms that we're dealing with have really shored up their cash flow, and whilst they've taken a lot of the government support debt, most of them haven't spent it and are really sort of positioning themselves for the future to capitalise on opportunities or utilising government-backed loans for funding things like the dreaded professional indemnity insurance, free of charge with the interest-free element. So, yeah, I think firms have adapted really well to what's happened.
Excellent. So that's our views. Next slide, please. So the question is, let's get a bit of a warming up and get participation. Now, if we were actually all in the same room, we might get you to stand up and touch your toes. And it would be quite funny to do that on Zoom, because it'd be interesting to see where everyone's got a Zoom attire. So we've dressed to our waist and we haven't actually changed our pajama bottoms or not. But we can't do that, so we'll actually ask some questions. So there's a poll here, and what we're interested in is really how optimistic you're feeling about the future. You'll see there's 4 answers, and deliberately put in the secretly optimistic. And I do a lot of work with lots of partnerships, and you get different views on the spectrum. And there's a lot of people who are secretly optimistic, but they don't want to tell anyone because it might not be what everyone else is thinking. So this is completely anonymous. So please do select one to see where you sit on this spectrum.
Had half of the attendees vote so far, so that's really good, everyone. And we're getting the hang of this stuff now, aren't we? Okay, almost 90%. So whoever's just popped out for a cup of tea, do race back and press the button. Okay, interesting. Do we stop at 86%? Oh, nearly 90%. I think we're doing pretty well. So I'll give you 5 more seconds to cast your vote, and then we will end the poll and reveal how everyone is feeling. Okay, so I'm going to share the results now. Hopefully you can all see that on your screen. Can you see that, Trish?
Right, so there's no accountants in the room because there's no pessimistic people apart from which is great to see. They always say the accountants are the most pessimistic, unlike myself, of course. So that's really pleasing to see. Stuart, is that what you were expecting from your thoughts about the profession and what you're seeing with clients?
Yeah, I think everyone's fairly buoyant, and cash seems to be coming in. There's obviously a lot of conveyancing work that's been going on, and yeah, things see people have just adapted, haven't they? They've had to adapt, and again, the government support from tax to the debt has been massively useful to allowing firms to continue, and confidence seems to have reflected in that.
It's quite interesting. The Law Society are running a new survey they're doing on a quarterly basis called Pulse. Some of you might have seen it, and they've done one for the first quarter, and most people are very nervous about an economic downturn. And second one is all about cash flow. So we can move on to the next slide, please. And as we say, cash flow is the heart and blood of the business, and it's important that we focus on that. Without cash, we don't have a business. If we can just flick over to the next slide, Pauline, if that's possible. And interestingly, from a cash point of view and where we're going, I just want to kind of just remind you what we were thinking, what everyone was thinking, where we are now, why we are where we are at the moment. So this time last year, the prediction was post-October 2020, cash flow would absolutely plummet because of the fact that we would have the VAT deferral to repay, we'd have the tax to pay. But come October 2020, when it was the spending review announcement, Hiroshi took the opportunity to actually say at that point, well, actually, you can do a time to pay for tax. So July instalments that were deferred, you then got to pay that plus your January over 12-month period, or if it was more than £30,000, you could have a conversation and it'd be a longer period. And then he announced that wonderful point where your VAT could be paid over a 12-month period, 11-month period, I should say, which was great news for a lot of people, as a lot of people were fearing that. And then we came to the budget in March, and of course there was lots of excitement about lots of different things, but it also meant one of the big announcements in the March budget, which really leaked out a couple of days before, was the extension of the SDLT holiday. And I know all those conveyancers in the room are absolutely jumping for joy when they heard that. So much more work going through, and the fact that it got extended to June and then there's this tail off has meant the buoyancy in the cash flow that we are seeing with so many firms is great, to the point what I've seen with quite a lot of firms is that the deferred VAT element from last year is being able to be funded out of normal cash flow. It's that good at the moment. And with some people actually putting that money aside last year because they were able to, just decided not to pay it, so we put the money aside because it was an insurance blanket. The fact that you can fund it out of normal cash flow at the moment is incredible. So let's just move on and kind of see where we are at this point in time. So almost take a stock take in terms of government support and just running through this point in time where we are. So furlough's just about to enter its final period. It drops down to 70% from June onwards. Up to the week commencing the 11th of May, there was around about 3 million people on furlough across the whole country, and that's down from the peak of 11 million. In terms of money being paid back, there was an interesting statistic out the other day. There's about £750 million of furlough money that's been voluntarily paid back. And it's probably a combination of people realising that, oh, maybe we've claimed something we shouldn't have claimed, but more a case of actually, we've done better than we expected, and therefore we've decided to pay it back. Now, there's no right or wrong on that one. That's what people have decided to do. The VAT deferral arrangement from last March to June, the interest-free loan, why wouldn't you take it? You have until the 21st of June in which to make that declaration if you haven't already. Most people have, but the 21st of June is the final cut-off to pay then over 8 months. If you don't, it becomes fully liable in one go. HMRC have got time to pay. We're still seeing time to pay on some corporation tax. The big one was really from January in terms of the January instalment. Statutory sick pay, small firms only, really linking to COVID. And the other one is the self-employment income support scheme. This affects individuals whose earnings were 50,000 or less in the 1920 tax year. We're in the middle of the fourth scheme, which closes at the end of on the 1st of June. And then we've got one last scheme, which is the fifth scheme, which will come out in July time. And the fifth one is a specific calculation as opposed to the fourth and all the ones before then. So if you are in that area where you can make that claim, the claims are getting much more scrutinized and harder to claim. So make sure you have your supporting evidence. And the final two things that the government support are really trying to push now is actually getting people back into work. So we've seen unemployment rates, they're hovering around 4.9%, which is great, but actually that's a generalization where they're seeing the big unemployment is really in the 16 to 24 category. So everything in relation to the Kickstart scheme, the apprenticeships and trainees is ultimately aimed at young people. There is actually a benefit for getting a veteran in if you want to do that, but it is about looking at those schemes and actually seeing if it can benefit your business, because there's some really interesting support there which could help you. And we're not just all talking about lawyers here. We need support across our whole business, be it admin function, support function, whatever. Have a look. There might be something for you. I think overall the support that the government has given has been incredible. There is no denying furlough has been a godsend for the country as a whole, but also for law firms. And when you look at the numbers and the performance, furlough has certainly helped get that profitability back to where it should be. I think what is going to be really interesting for the Chancellor going forward is then when we hit our next crisis or whatever it will be, because we will have these recessionary periods, the question is, will he bring furlough back? So moving on. One of the big things that happened last year was the CBILS. I just want to give you some stats and then pass it over to Stuart to really talk about his experience of it, because he was in the nitty-gritty of it all. So the biggest support was CBILS and Bounce Back. We can't ignore Bounce Back. And we did a Freedom of Information request to British Bank back in February, asking how much happened in the legal sector. So up until the end of February, there was £550 million of CBIL funding into the legal sector, which equated to 1,600 applications, which made an average CBILS funding of about 319,000. More interesting in some ways is the bounce back loans. There was £179 million of bounce back put into the profession, of which there was just under 5,000 application. So the average bounce back was around 36,000, which in the context of the whole country was about where the average was. Now, if you think about the number of law firms that there are, there's around about 10,022 at the end of April. That equates to around 65% of the whole profession that have taken some form of government support. And it also demonstrates how fragmented this profession is, because there's a lot more bounce backs than there were CBILS. But I know people went for bounce back straight away and sometimes replaced them with CBILS. Now, Stuart, what was your kind of experience over the last 12 months in terms of the CBILS, how it changed over that 12 months, both in terms of amounts you could borrow, rates of interest, all those things? What did you see?
Yeah, I think for the last 12 months, all we've talked about has been CBILS. It's definitely taken centre stage, and early on we felt that it was key to shift our whole business model to focus on this, because we knew that the appetite was going to be for CBILS and the government backed funding. Why wouldn't you borrow on these terms? So we've done a lot with it. I think any law firm who borrows money has explored CBILS or the bounce back loans. So we in the last 12 months have funded 40 million of CBILS, with 28 million of that going to the legal sector. And really an array of different funding requirements. So we've funded business development, we funded acquisitions, mentioned earlier. CBILS has been used to fund the dreaded professional indemnity insurance on an interest-free basis, because although they may have taken a 5-year facility, their plans are to utilise that initial 12 months interest-free in place of traditional PI funding, and then settle it in 12 months' time. So that's been quite popular. So we've helped.
Did you see any rate?
Say again.
Did you see any rate changes throughout the year, or are actually rates quite consistent?
Yeah, pretty consistent. So the best rates that we were getting were about 2.1%. Flat rate, so that was an APR of about 3.37, and no more really than sort of 7% at the higher end of the rates for smaller firms, and we expect that to move forward into the new recovery loan scheme as well, possibly a touch higher on the rates, but yeah, we expect it to stay fairly consistent. But what's interesting is the funders that we were dealing with are what you'd probably class as the alternative funding market to traditional high street banks. And they were a lot more open to some of the loan purposes that we were able to organise funding for than what the high street banks were able to lend for. But yeah, obviously the high street banks will have funded a big percentage of the CBILS that was provided, but I think a lot of that was funded with the backing of existing debentures, whereas a lot of what we did, especially for the bigger facilities over 250, was to piece different tranches of funding together from different sources to achieve those larger amounts. So that was a big part of what we did.
Interesting from our point of view. I think the highest CBILS loan that we saw was around 2.5 million. The lowest was probably about 150. And the bulk of that really was insurance money, people not knowing what could happen. And because, let's be honest, it was cheap funding, because it was designed to be cheap to help people took it. And I don't blame them for that. We'll talk about what the impacts of that are later. But it's interesting that I don't know if people remember back in October, Rushi came out and said, actually, you'll be able to extend your repayments over 10 years. Now, we've not seen anything on the CBILS front of that, but we have seen it on the bounce back. So it's called now pay as you go. And you can make an application for that, either depending on who your funder is. You need to go to your funder about paying that back over 10 years, not 5. But the rate of interest stays the same. I doubt whether we'll see that on CBILS straight away. I think it's going to be a refinancing, which brings us nicely on to what's happening in terms of the alternatives. So CBILS came to the end at the end of March. Stuart is still frantically working away on a final few, which he's doing for me as well as other people. But that ends at the end of May, and he's probably not going to have so many grey hairs by the end of May after this finishes, because it's been a little bit stressful. But what's the alternative?
So we've done a little piece on the recovery loan scheme in conjunction with the NACFB and the British Business Bank a few months back. So we've gleaned a bit of insight into the new scheme. Some of you may already be aware of what's on offer, but in essence, it's an amalgamation of the previous schemes into one recovery loan scheme moving forward. So if we could grab the next slide, please. So this is all about the Build Back Better ethos that the government have, and the government looking to support going forward to help those firms grow out of the recession. I know a lot of law firms have sort of held back their capital from CBILS, but there is the additional support for recovery loan schemes, which can be used for, again, a number of loan purposes. It isn't limited they're fairly flexible as to what they will allow the funds to be used for. So we can just go on to the slide. Just outlines kind of what, sorry, that was just outlining what had been funded on the different schemes. And now, yeah, we go on to the amalgamation of those three schemes into one. Government is still providing 80% of the outstanding balance of any loans taken. No interest free period on these loans, so it'll be straight into repayments. But interesting, there's no minimum turnover, so a lot of the smaller firms that weren't able to access CBILS may well be able to offer access the recovery loan schemes and achieve perhaps higher advances if their cash flow forecasts and plans are deemed strong enough to achieve these higher advances. The RLS scheme will be available through a network of accredited lenders. Most actually are still going through that accreditation process. Most of the funders that we dealt with are still getting their accreditation. I think a lot of them have still been tied up with CBILS and wanted to get that fully completed before they dived into RLS. So you'll see probably a lot more over the next month or so that become fully accredited. Next slide, please. So yeah, business can choose from a variety of products. So the RLS can be used for term loans, overdrafts, asset finance, invoice finance, and we did find out this week that RLS can also be used to support commercial mortgages as well. So we'll wait to see a bit more about that as well. Minimum value of the loan starts at £1,000 and can go up to 30 million for a group of companies. No personal guarantees up to 250, and PGs may be taken over 250 if the lender deems necessary. No turnover restrictions for businesses accessing the scheme, which we touched on before. Next slide, please. And then you've just got a brief sort of comparison between the previous CBILS scheme and the new recovery loan scheme. So yeah, again, government pays the first 12 months interest on the CBILS, which they won't be doing on the recovery loan scheme. It really is just that 80% government guarantee and the no personal guarantees up to 250 that are of real interest on the new scheme. Next slide, please. So yeah, the spirit of the scheme, as with CBILS, credited lenders will pay brokers a commission, or did pay brokers a commission. It'll be the same with the RLS. Brokers are generally paid between 1% and 3%. And lenders are expected to charge no more than they normally would with a comparative commercial loan. I have to say there are or were brokers charging additional broker fees on the CBILS scheme. We didn't feel that it was right to do that. So we were just paid by the lender with no additional broker fees charged to our clients. Next slide, please. Spirit of the scheme again, business is able to refinance part of the existing debt. So you may have firms that are now starting to make repayments on CBILS loans. They can possibly refinance CBILS loans into longer term RLS facilities or higher RLS facilities. So that's something we can look at. Brokers should be establishing solutions to work best for their clients, which may not include the RLS scheme. So we aim to look at sort of all options, but with the personal guarantees not there for up to 250k, it is probably a favourable option for many. Next slide, please. And then these are the lenders that have been accredited so far. There have been a few more. I think Investec and close were accredited yesterday, but as I said before, there will be quite a few more coming on board. And that's it really on RLS. So I'll pass back to Trish.
It's interesting, isn't it? CBILS and RLS always strike me as the old business enterprise scheme, with this kind of the government back bit and a personal guarantee bit. So they kind of just evolved, don't they, in terms of something slightly new, but the basic principles are the same. Okay, let's move on to the next slide and let's start talking about the future. So we know short term at this point in time, we're feeling quite optimistic or very optimistic about the future. But actually, when we look at the short to medium to long term, where's everything going and what should we be thinking about as law firms in terms of how we structure our finance? So in the very short term, so we're talking between now and probably next March, we've gone through a phase of CBILS top up. March was incredibly busy, definitely for Stuart and myself. We were chatting about lots of clients topping up with CBILS, because why wouldn't you? The opportunity to do it in order to get some very cheap funding is available, and certainly done quite a bit of that over that period, which is why probably RLS is going to be slow on the take up to start off with. In terms of overdraft support, what I'm seeing in that respect is, you know, the initial feeling is we've got so much money in our business, will the bank take our overdraft facility away? What I'm seeing is actually banks are not looking to do that. The only changes that I do see is perhaps where clients probably had overdraft facilities that were a bit higher than they should have for their type of business. It's crept up over a period of time. And actually what you're seeing now when you look at the swing, and that's what an overdraft should be about, is monitoring the swing in your cash flow is actually much better. So bringing down overdraft levels. Overdrafts are really expensive for banks to fund. It's in terms of their balance sheet, how much they have to put aside. So always looking at that funding side is really important. We'll come on to security and things like that a bit later. The big question I get asked is, should I pay back my CBILS money? A lot of people took it out for insurance money purposes. A lot of people aren't using it and think, well, it's there. I don't need it, Trish. Shall I pay it back? My biggest answer in 99% of the cases is no, unless two things are prevalent. The first one is your actual rate you're paying on your CBILS money higher than your overdraft facility? And therefore, because your overdraft fluctuates, is it actually cheaper to have the overdraft and not the CBILS? And that's quite interesting. And as Stuart said earlier, some of the rates are so cheap that actually, why would you pay it back? The second one really is, will it impact on your overall funding of the business? And what I mean by that is actually internal and external debt. So internal overdraft loans, etc. External, the funding from partners into the business. So does that impact on future partners, for example, buying in? And if it does, then we need to be thinking about it, because one thing is really, really important is that no matter what you take from this webinar today, one thing you do want to take away is, although these schemes are great and they have their places, we must match the right level of debt in terms of the term with the type of funding that we're doing. So we don't want to mess up short-term funding with long-term needs, because that's not the right way to manage your business. You will trip over if you do that. So what my question is, whenever you're looking at your overall funding and you're looking at potentially partners buying in and needing funding, conversation with whoever you're having with your funder, is that impacting what we need to do? Do we need to pay down some of our CBILS to allow the longer term funding to be right? As Stuart mentioned earlier, the PII, CBILS was used a lot. If you look at the statistics we got from the British Bank, the peak of CBILS funding and BBL funding was May, and then the second peak was in September, October, so when people were taking funding. My only personal worry, and Stuart knows about this because we chat about it a lot, is taking the CBILS funding for PII was a great idea because it meant interest-free funding will needed in that 12 months post taking it, putting that money aside as though you were paying back the loan. If you've done that, I think that CBILS funding was brilliant, because now what you've done is you're being able to then repay that straight away in September, whatever day it's going to come back. My worry is people who haven't done that, you're going to end up with a longer term debt and then having to take out more debt to do this year's, probably with the RLS, because I think, Stuart, you'd agree it's probably the right use of funding for going forward on PII, but you're going to start mixing that debt up and using the wrong term of funding for the wrong thing. So I just want to make sure that if you have used CBILS for your PII, you've got that discipline of putting money aside every month like you would have if you had to take the funding out. So you make sure that you can pay it back in one go. I think what will be interesting is paying the tax in respect to the latest financial accounts. Firms have, to a certain extent, taken the time to pay arrangements with the revenue for January. The revenue are incredibly generous at the moment. They are feeling very happy. We are seeing some amazing time to pay results. If it's anything like last time when it was the financial crunch, we saw a happy revenue to start off with, and then the tide turned, and then they became harder with time to pay. So it's a question of whether this facility will be there in January. We don't know. No one knows. There's no announcement. We haven't seen anything for July yet either. And it's a question of, if it's not there, what's our alternatives? Stuart, are you seeing any products, any change in products in relation to funding of tax at all? Do you expect any changes?
So yeah, tax funding is fallen off a cliff really for the last 12 months because of the government-backed support and with loans and time to pay arrangements. We do get a mixture, I have to be honest, with law firms not necessarily wanting to enter into official payment arrangement plans. I know we discussed this a bit as well, but some firms simply just don't want to be in a payment arrangement plan with the revenue. Others are quite happy to be. But in terms of funders, those traditional tax funding products are always there, as well as the VAT. But I think firms just haven't wanted to opt for them and opted for other options. But I do feel that may swing back. But you never know. Firms are fairly flush in the main at the moment. And I think, as you said, as the revenue perhaps get a bit more tight with the purse strings, they perhaps won't offer these schemes for forever. So I suppose we'll have to wait and see on that.
Yeah, I think from a personal point of view, I haven't seen anyone do any VAT funding over the last 12 months. There is a place for VAT funding for certain types of law firms, but if you can avoid it, I think it's really good in that respect. So I think the opportunity to take CBILS to help you sort out your position and manage your business as a whole has really helped people get out of that cycle of VAT funding, because once you're in it, it's quite difficult to get out, isn't it?
Yeah, agreed. I mean, we do enjoy organising VAT funding for clients when they need it. We have some really keen options for that, but yeah, I think there's a time and a place for it. Some firms will just use it for one quarter in the year, and others will use it as an ongoing cash flow tool. But I think, you know, with the funding that's been released, it does help firms get out of those shorter term facilities that, as you say, are pretty difficult to get out of. Yeah, we may see VAT funding come back, but firms may have taken a different view on whether they wish to do that going forward.
I think because lots of firms have had a good year, or better than expected, and with these delays in paying tax, which you have on your profits. So if you're March year end, March 21, the catch-up payments next January. If you're in April, it's the following January. It's just having the discipline to make sure that we are completely know where we're going in terms of our tax, and it doesn't get forgotten. It's quite important. There's some really interesting stuff coming down the road in terms of making tax digital, where that will go in terms of tax payments, but we have been promised there'll be no changes in this Parliament in relation to tax payments. That's another subject for another webinar, I'm sure. Let's move on to the next slide. So that's our short term, but actually what's our medium to long term challenges? And they come round two things in particular: succession planning and growth. And this is really quite interesting. Succession planning comes in two things. It is people looking to change in terms of how long they want to be in the business. And what I'm seeing, the conversations I'm having now, is people actually, where they were saying to me, you know, Trish, I think I've got 10 years left, perhaps 5 years full-time, 5 years part-time, and then finish. Suddenly it's, I think I only want to do 5 more years, maybe 2 years full-time, 3 years part-time. And that changes the dynamics in a lot of businesses, which makes succession planning even harder than it has been before. Let's be honest, this is a fundamental problem, not problem, challenge that lots of firms have and have had it throughout probably the last 20 years. So this is nothing new. It just highlights it. The difference now compared to 2007, 2008, when we were talking about succession planning, is people wanted to hang on. Because the dip was quite severe and took a number of years to come back, what people found is actually their pensions weren't in the right places, so they wanted to hang on longer, perhaps longer than most people wanted them to, but that's a different story. And therefore, it delayed succession planning. What we're seeing now is perhaps people have had to think about their lives and what they want to do, and saying, well, actually, is there more to life than work? And actually, it's pushing that succession planning shorter. What we're also seeing is the M&A market is growing. There has been huge amounts of activities. You've seen quite a few announcements over the last couple of weeks. M&A was at its 20-year low last year. We're expecting a lot of activity this year. Partly things catching up, but actually lots more people thinking about it. There are definitely more buyers than sellers in the market at the moment, which makes it a very interesting place to be. The other part is growth. And what does growth mean? Growth is two things. Growth in turnover comes from M&A, comes from bringing in more people, and there's growth in profit margin, comes from investment. This is where I think CBILS is an absolute godsend for a lot of people, because that money has given people opportunities to think differently about what they're going to do. So it's allowed them to invest, hopefully, into improved profit margins, so invest in technology, process, etc., all those kind of things. But it's also allowed them to grow, take on people perhaps a little bit quicker than they would have before, because they can afford, from a cash flow point of view, to allow that growth to come through. It takes about average 9 months for a fee earner to really get on board. And that's where I think CBILS money should be used and really help the business move forward, perhaps quicker than they had before. And the final areas that's always going to be our challenge is professional indemnity insurance, where it's going to go, what's going to happen. I'm no expert, Stuart's no expert in this area. We help fund it. We help advise on funding and things like that. But what we do know is the market is difficult. We've been told it's going to be difficult for another year. So September is probably not going to be an awful lot of fun. So that's really our challenges. So how does that fit in terms of our funding going forward? Now, before we look at that, we just want to ask another question, which if you move on to the next page, it's all about where you have your debt. So do you have all of your debt with your main or your primary bank, or do you have it actually with a different sources, some with alternative sources or different banks? Just want to get a feel, and there's a reason, as people who know me, I always ask the question for a reason, and we'll explain that afterwards as we go through the next stage. But it'd be nice to know, how does everyone's debt fit at the moment? Perhaps you have no debt. So if you have no debt, what would you have done if you have debt?
Okay, we've got 50% of people have voted already, so climbing up. Give you a few more seconds. Should be an easy one, this, although I don't know. Maybe everyone's frantically looking through their paperwork. 65% of you have voted so far. Okay, maybe you're not in a position to know, actually. It depends on your role, doesn't it, in the firm? Yeah. Okay, I think that's probably everyone who's voted so far, so that's 65%. So if we just end that in a second, I'll just end that poll and share the results with you. There you go.
Oh, it's not bad, pretty even.
50-50. What did you expect that, Trish?
I probably expected a higher amount with the main bank.
Yeah.
What were you hoping? Or expect? No, what were you hoping, Stuart?
No, I think it's just quite interesting that I think a lot of firms are more open to spreading liabilities and not perhaps having it. I know I say this often, but having all their eggs in one basket with the bank. I think from the last recession, 2008. A lot of firms started to look outside the bank, and I think that yeah, I mean, there's a lot more options nowadays, and competitive rates as well. So so it's interesting. It is interesting.
Do you think that perception of alternative funding was always going to be more expensive, so people didn't look, and actually the last 12 months, the experience of alternative funders for CBILS has changed people's minds?
I mean, I've been doing this for sort of 15 years, so I think I've seen a big shift from firms staying with their bank over the last over the last 10, 15 years to now shifting to looking at the alternatives. Yeah, there's competition, and with competition that makes it better for the sector. So however, there are funders that have pulled out. Investec pulled out of providing professions-based funding. Yeah, and CBILS has kind of taken centre stage. So whether they will come back, those funders that have left later on, remains to be seen. But again, we shall see what the next 12 months holds.
And do you think they went out because of bad debts? A bit like the insurers, people go out because actually their book is just negative as opposed to positive in terms of experience legal firms, or do you think there's other reasons they pulled out?
Yeah, probably a bit of fear, I suppose, and just to shore things up and take stock. I suppose, yeah, from a funder's perspective, it came around so quick and caught them off guard. Yeah, we'll see. But interestingly, we'll probably go on to this more, but the funders offering the buy-in loans for practices, which are probably jumping the gun on a little bit, but yeah. Partner buy-in loans seems to be an area that needs more activity and more funders. We're speaking to a bank called Recognise about a buy-in product, so we'll release more details on that, but it's definitely an area where we hope to see more players.
Okay, let's move on to the next slide, and let's talk about actually what are we seeing in the long term, the medium to long term, in terms of funding, and this is just kind of our views on it. Let's start by going back a step, actually, and where the playing field has changed slightly. On the 1st of December 2020, some new legislation slipped through, which a lot of people didn't see because they're far too busy fighting the crisis of COVID. So from the 1st of December 2020, the revenue have now become preferred creditors, and they've got the preferred creditor status. Now, they did have this in the past. They just lost it, and then it's come back again. And it's kind of sipped in underneath the radar for a lot of people. But actually, what it does mean for the primary lenders is that actually the debenture that you had before may not be as secure as one had perhaps thought it would be, with the revenue taking precedent. And in terms of looking at that security and looking at overdraft facilities and what this means, on average, and every bank is different, so I'm going to give you a generalization here. When you're looking at your facilities that you have with your main bank, you're looking at coverage on your debtors and your WIP. Usually it's up to about 90 days of debtors and WIP, sometimes more depending on the type of practice. And now when they're calculating the coverage, you're usually taking off 3 months of PAYE, 3 months of VAT. And at the moment, with the VAT deferral, whatever you've got deferred will also come off. Now, if you've got that money actually set aside in a bank account, that can be ignored. But if you take that, just think about your own practice for a moment and do that calculation, with 3 months VAT, 3 months VAT and PAYE coming in, suddenly that exposure is so much greater for the banks in terms of what coverage have we got. There were a couple of banks making a few headlines to start off with, saying actually this might need to change it and go into PGs because our coverage is not as good. But what we are finding with the banks at the moment is that actually it's calming down, and people are saying, well, actually, yes, that's part of the equation, but a bigger part should be about the business as a whole. How well is it run? What's its profile like? What's its history like? Is it actually a profitable business? Has our exposure really changed? And if we're close enough to our client, actually, should we be worried about it? But I do think that whole change of preferential creditor status has caused a difference. And then when you look at what could happen in relation to the alternative fundings, and in particular the CBILS, and where that goes, that's changed. So, Stuart, in terms of your experience, when we think about the alternative funding for tax and VAT loans, they were always personal guarantees, weren't they?
Often, yeah. Apart from either very strong firms or partnerships, because they're automatically personally liable. But yeah, as the viewers will know, if they've borrowed money through alternative sources, yeah, generally PGs were asked for, but obviously not with the CBILS scheme.
So do you see a shift for people using CBILS and RLS and those type of schemes because of almost the government providing that support to them, as opposed to having to do PGs? And maybe people now think of alternative providers more so than primary providers. Do you see that kind of shift, deliberate shift then?
I think I mean, the terms are so good that, as I said before, why wouldn't you borrow on these terms and try and either reduce some overdraft, some exposure to the bank? Maybe firms have tried to increase overdrafts in the past, and banks haven't been able to get comfortable with a higher overdraft limit because of preferential creditor situations. So maybe firms are looking more at the alternative finance options more so. So it's an interesting concept, I think. But sorry, there's a bit of noise in the background. The RLS scheme, I think, will be used to replace a lot of the traditional funding options such as PII for next year or later this year, where PGs have previously been provided, but obviously through RLS they won't have to do that.
And then if we move on to working capital funding and partner capital funding and where that's going, I think the days of 25-year interest-only type loans to support capital to be brought into the business, those days have gone. We're not really seeing any of that. We are seeing 10-year funding, perhaps 5-year interest only, 5-year repayment, and we have seen some 10-year interest only, and that tends to vary the size of the practice. What we are seeing more of a challenge, which Stuart touched upon earlier, is with so many firms either converting to limited company status already there, when owners are coming out of the business and new owners coming in, particularly new owners coming in, being able to fund that properly. And it's buying share capital, not buying in through loans. I know there are some banks out there that will provide funding to come into a company, but that usually is through a director's loan account, which is deemed to be subordinate loans, which is great. So it's not impacting the whole business, but actually what we need is a product that actually allows people to buy in through share capital. Now, I completely understand from the bank's point of view that that's funding goodwill, and goodwill is an interesting concept. And like I say, we don't have enough time to talk about those kind of things today, but it's getting comfortable with that type of funding. I think there's a gap in the market for that type of funding for the right type of business. We have seen some funders pull out last year in terms of that type of funding. But again, I think it's just understanding the sector, isn't it? What do you think, Stuart?
Yeah, as you mentioned, I think Wesleyan Bank were doing quite a bit in the partner buy-in loan side of thing, and they again pulled out. I'm not sure again whether this is to do with it being more sort of regulated type business, whether it's the type of debt that they want on their balance sheet, but it does appear that it's not the right type of capital for a lot of funders, especially when it's a limited entity. So again, there's a definite gap in the market for that type of funding. We're speaking to a bank called Recognise. Again, it's not formalised, but we hope to be able to release something on that front in the future. So yeah, as you said, there's a definite gap in the market, and it's important to keep a sort of keen eye on that space, because there aren't a lot of players in the market at the moment.
I am watching it very carefully. I have a very big interest in that. There are alternative ways of doing these things, but you know, usually they're more complicated, more administration. In terms of rates, let's be honest, where base rate is at the moment, it's not going to stay there long term.
Can I just jump in there? One of the methods that we have been using with this lack of the sort of partner capital loans was lending to the firm, and the firm then organising an internal agreement as to how that debt is repaid and who is liable for it. I know you hate that model for a buy-in, but yeah, it's something that we have been organising, and using C-bills for that as well.
Yeah, my issues personally with that are twofold. You're mixing up long-term, short-term, and if it's main debt, not subordinate debt, it does impact on other funding that you want to potentially do. So that's my reservations in terms of, are we doing the right thing for the long term? I get the short term, but long term it's not.
Yeah, it's not a long-term solution,
right, in my opinion.
Agreed. Yeah, it's definitely not a long-term solution, but yes.
I think one thing's for sure, rates are going to only go in one direction. Our good old friend inflation is going to be forcing that, which will come at a vengeance with us towards the end of this year. It will be at that 2.5%. Depending on which economist you listen to, we're probably looking at a rates rise first quarter of 2022 at the earliest, but we're probably about 2.5% interest rates within 3 years. So watch this space. It's a bit of a double-edged sword really in the legal profession, because of the fact that we want decent interest on our client monies, and boy, aren't we holding a lot of client monies at the moment, but we'd rather not pay it on our debt. So it's just a balancing act. One thing I just want to address, because I'm conscious while we're running out of time, because we have so much to talk about, is impact of C-bills. There is still an unknown in that area in terms of the impact of what it's going to have on other funding. I know talking to some bank managers, particular client was looking at funding to acquire a property. The bank was saying, well, we might not be able to do 100% loan to finance, where you could have in the past because of the C-bills. So you've got to really think about that quite carefully. I'd also, as a tip, really think about your application form for professional indemnity insurance this year. As you know, the wonderful form you fill in gets longer and longer, but there's a particular part, as always, on finance. And there were some questions last year. There'll be more questions this year about funding. And what you don't want is the insurers to think that you had a problem in terms of you had to have a C-bills. They have been for insurance purposes only. So have the opportunity to write something on your form to say, yes, we took one out purely as a safety blanket. We've kept the funds, we've not used it. Make sure you get across that actually it's not impacted on the business in any shape or form. So finally, I'm conscious with 1 minute to go, we will let you have the slides. If you just move on to the next slide. Whatever your funding, whatever your structure is, fundamentals of good practice management is budgets and forecasts. I cannot emphasize enough the need to do forecasts, actually a detailed first year and a 2-year rolling forecast. Where are we going? What are we doing? That will help you then assess how you'll use your C-bills and what the impact will be. Lockup, reducing lockup is the cheapest form of finance there is, and it's the one that people should be focusing on. It's the one that every fee earner can contribute to help the business run more efficiently. There is no right or wrong at the level of capital you have in your business. It depends on the type of firm that you've got, how many partners you've got, how you're structured. It's about being comfortable with it and managing the acceptable debt within a certain parameters. And always remember that you've got to pay debt out of profits. You can't draw out all of your profits if you've got debt to repay. It doesn't work. All it's going to do is expand your overall debt. So, conscious of time, do we have any questions?
If anyone wants to ask a question, just use the Q&A or the chat function. and we'll be really pleased to answer those.
Yeah, we've got a question from Martin Best. What's your views on any likely increase in solvencies as cash positions unwind? What tips would you give to anticipate this? Thanks for the question, Martin.
The general point at this point in time is insolvencies are down by 23% compared to this time last year, which is no surprise because of all the support. Do we expect it to increase? Yes, there'll be a slight increase. I don't think there'll be anything significant because I think people are there to support. The revenue will not push people over because it is not good publicity. I do think funders are there to support as well. In terms of tips, cash flow is everything. Forecasting is so important, but actually measuring yourselves against forecast. Don't do it and then put it in the drawer and say, well, that was an interesting exercise. You have to keep looking at it and reforecasting to make sure you're on track. Put yourself benchmarks of where you should be and monitor it. Benchmark is such a strong thing to have within your practice. It keeps everyone on track, and make sure that your lockup isn't getting out of hand. As businesses grow, lockup increases, and therefore inevitably cash gets absorbed. You need to keep an eye on all of those things.
Okay, do we have any other questions before we wrap up the session? That's our question slide. So if you do think of something that you want to ask Trish or Stuart, obviously look at the membership tree on the Calico website, or drop me an email on info@Calico Legal Group and I'll pass it on and they'll get in touch with you. Thank you very much for joining today. I hope it's been informative, and thank you so much to Trish and Stuart for such an expert session today on finance. The next session is on the 24th of June about the Know Like Trust path for business development and marketing. So hopefully see you there. Just a heads up, if you haven't looked at the chat, the July webinar on the 15th of July is with Lockton and Amy Bell from Teal, all about professional indemnity. So that's a good segue into that one. So do register for that one if you can.